Greetings all. This is going to be part one of a series of videos on financial statements. Whether you are considering starting your own business, evaluating investment opportunities, or simply aiming to enhance your financial literacy, understanding financial statements is paramount. With a background in engineering and a journey that led me through the corridors of business management, I have traversed the path from financial ignorance to enlightenment. Now I'm here to share that knowledge with you all. Throughout this series, we will be dissecting financial statements layer by layer, and by end of these videos, you will emerge as a savvy navigator of financial landscapes. Before we delve into the details, here is your daily dose of motivation. As Armstrong once said, it's one small step for man, one giant leap for mankind. Similarly, the small step you're taking today, it's going to expose you to the vast world of business and finance. A company needs to communicate its financial position to various stakeholders for various reasons. For example, it creates reports for internal management so that they can make informed decisions, external stakeholders like shareholders, or for tax authorities for tax purposes. There are five key reports that are prepared for external stakeholders to convey the message around company health. When you read them collectively, that will give you insights in a company's financial performance and operation. These reports are balance sheet, income statement, cash flow statement, shareholder equity statement, and comprehensive income statement. Today, we are going to look into balance sheet. A balance sheet is a snapshot of company's financial position at a specific point in time. It provides a detailed overview of assets, liabilities, and equity. In short, it's financial health. Companies usually prepare balance sheet on the last day of the financial year. So, there are three main components of a balance sheet. These are assets, liabilities, and equity. And the relationship between these three components are governed by the equation assets minus liabilities equals to equity. This has to be always true, otherwise the balance sheet is wrong. Okay. Now let's look into each of these components. Starting with assets. As the name suggests, something the company owns and can be used for future benefits. We can classify it into two different categories. Current assets, these are assets due to be matured within 12 months, and non-current assets, these will mature beyond that period. So the only difference between them is the timing. From the screenshot, you can see some of the common assets. For example, cash, then trade receivables. So basically, if you sell a product to a customer but you didn't receive the money yet, they are recorded here. Inventories of your company, and inventories are usually recorded as the lower of cost of the product or net realizable value, as in if you were to sell the inventory, you need to pick the lower of the two and record that in this section. On this page you can see some of the non-current assets. For example, plant and equipment that you use to produce your products. Then deferred tax assets, which means if your company made loss in one of the previous financial years, you could use that for one of the later financial years and claim tax deduction, which is considered as a tax asset. Then intangible assets, for example, your company's brand name or goodwill. Okay, let's talk about liabilities now. Similar to assets, you can classify them into two categories, current and non-current. And the concept is exactly same. Liabilities that are due to be settled within 12 months, they are considered as current liabilities, whereas anything beyond that are non-current. So the only difference is the timing. And from the screenshot, you can see some of the common current liabilities that you would find on a balance sheet. For example, trade payables, deferred revenue, provisions. So things like long service leave of your employees. And the last part of a balance sheet is equity. Equity is usually made of three elements: contributed equity, so owner's fund, then reserves, for example, foreign reserve of the company, and then retained earnings, which is the amount of profits or earning retained by the company. Now, putting everything together, you can see the structure of the balance sheet. It has assets, liabilities, and equity, and a balance sheet needs to be always balanced, as in assets minus liabilities always equal to be its equity. Now on the right hand side, you can see two balance sheets of a real company. One was produced in 2018 and the other one is from 2019. If you compare the two balance sheets, it will give you the financial health of the company at the time of the report. Looking at the report, can you tell, is the company financially stronger or weaker? That's an exercise for you. Okay, so that was all about the balance sheets. Stay tuned for the next video on income statement, where we delve deeper into the building blocks of financial statements. If you like my contents, don't forget to like, share, and subscribe for more. Thank you.